Thank you very much. Good afternoon to you all. Glad to be with you. I wish it was a more prosperous kind of outlook that one would be looking at, but let me give you the different scenarios that one is looking at right now. If we start off with economic growth itself, one notices that economic growth forecasts in recent months had been revised slightly upwards from almost zero to closer to 1%. But that was at a time when people were starting to be a little more optimistic based on the first and second quarter GDP figures, which both turned out to be somewhat better than had been expected. And we realized at the time that a load shedding did not turn out to be quite as severe as we had anticipated, and fixed capital formation had been improving somewhat. Unfortunately, since then, we received the third quarter GDP figures, which were worse than expected and which were characterized by the first marked slowdown in fixed capital formation. You can see it on the bottom graph. After having had 2 years of stronger growth in fixed investment, we suddenly had a dip in that investment. We also had a rundown of inventories after having had a couple of quarters of strong inventory improvements. And that has forced one to scale back one's forecasts for growth in 2023, certainly somewhat back down closer to 0.5% than closer to 1%. Although one is still a little more positive about 2024 for what it's worth in looking at economic growth, more like 1.5%. Our own forecast is 1% growth. Unfortunately, what we have seen is a resumption of load shedding. One isn't quite clear just how serious it is right now. But the other big negative that has really emerged in the last few months has been the bottlenecks at our ports, which are inhibiting our ability to bring in goods and to export goods. So it's negative for export. And by constricting the ability to import goods, it's raising the cost of producing a lot of goods that use imported inputs. And directly in the retail sector, where goods are immediately imported, there's a shortage, and that in turn also can lead to higher costs thereof. So more or less, we're looking at growth of 0.5% in 2023, improving to 1% in 2024. That puts us, I mean, if it's any consolation, in line with the UK and the Eurozone, if not marginally better. But remember, they have population growth rates far lower than the 1.5% population growth rate that South Africa has. And in relation to the rest of the world, you can see our economic growth is certainly still at the lower end, which is unfortunate. While I've got the graph, the table on forecasts, you'll see China came out last week with economic growth for 2023 of 5.2%, but that is forecast to slow significantly. Some are even saying just 4.2% for 2024. And the reason why it was slightly higher in 2023 was because that was a comparison against 2022, when, if you recall, China suffered its severest bout of COVID, and the economy hardly grew by no more than 3% at the time. So 2023 figure gives you 5% because it's compared against a low base of just 3% in 2022. On the positive side, one has the US doing somewhat better than had been anticipated. In the past couple of quarters, we've seen growth of nearly 5%, but that is expected to slow to 2% or even less in 2024. The big debate is, or has been until recently, whether there's going to be a hard or a soft landing in the US. And most forecasts are now tilting towards a soft landing, because the data that are coming out of the US on a day-by-day basis are amazingly strong. Last week, we saw retail sales growing by 0.6% month on month in December. Its fastest pace in many, many months. Industrial production also improved, and the University of Michigan Consumer Sentiment Index rose to its best level in almost 3 years. It's amazing, despite the fact that interest rates have risen so much. And a lot of that has to do with the fact that people are able to have been able to fix their mortgage rates at much lower interest rates, and have been reluctant to sell their properties in the interim in order not to have to renegotiate a mortgage at a much higher rate. And that's also caused a shortage of supply of properties in the US, which has tended to push up their house prices. On the negative front, the Eurozone looks as if it's going into recession right now, and that we see some rather weak figures all the time. And by the way, that's quite interesting for the outlook for the dollar, because on the face of it, the dollar has been under pressure more recently because of the expectations that US interest rates would fall significantly before Eurozone interest rates. But on the other hand, what's preventing the dollar from falling too far is the fact that the US economy itself is doing much better than the Eurozone, so that in the longer term, right now, the feeling is that Eurozone interest rates in the longer term might fall faster than those in America. And so that in turn argues well for the dollar. And in our forecast, basically, we've got the dollar remaining more or less at $1.10 to the euro and $1.27 to the pound going forward. We've stuck to that, to the dollar remaining more or less at current levels. If we go on to looking, though, at the South African economy, you will notice the productive side is still doing quite poorly. We will know, if you look at either mining production or manufacturing production, neither is anywhere close to the levels that were seen pre-COVID. The last couple of months' figures have been slightly better, which is encouraging. And that leads, and the PMI figure shot up quite nicely. And that suggests that it's not totally doom and gloom, but one cannot get too excited about it. South Africa is in a phase of deindustrialization right now, and a lot of that has to do with concerns about energy shortages and a lack of investment, therefore, into more energy. The government itself has brought out a new integrated resource plan regarding our energy mix in the future. And it hasn't actually met with a lot of agreement. People have been a little disillusioned. They feel that the government is dilly-dallying about moving towards renewable energy and is backtracking on wanting to phase out coal-fired power stations more readily. As a consequence, there's also a feeling that the government is backtracking on ideological grounds. It's just trying to avoid letting the private sector really run with producing energy the way it ought to. And on the mining side, the devastating manifestation last week of the fact that out of 2,500 applications for mining licenses last year, not a single one has been processed. And one gains the impression that there is pushback on the part of the government ideologically, especially with the unions and the Communist Party in cahoots, not to have much to do with the private sector. And of course, if that is the attitude, then we're not going to make the kind of progress that we really need to in terms of addressing the structural impediments to the country. Classic example of that more recently is the fact that a Filipino consortium of port facility investors offered to try and fix our ports, but the unions are up in arms about signing an agreement with a private sector company. And so we end up with just not being able to bring the goods in and services. The unions are more determined to save jobs with a very short-term outlook, not realizing that at the end of the day, they're actually jeopardizing jobs within their unions from a longer-term point of view with their attitude. If we go on to looking at consumer spending, here there has been a noticeable reduction. It's not collapsing, but in the last few months, we've had negative growth in retail sales. It improved slightly in November, and we ended up with minus 0.9% instead of minus 2.5% in October. One of the factors that is emerging is why there has been a gradual weakening of retail sales and passenger vehicle sales more recently, is the fact that people have become more reluctant to borrow money in the face of high interest rates. And through 2022, retail sales were supported to some extent by moves to borrow more money to compensate for the erosion of their disposable income. But that has certainly slowed in recent times, and we see consumer spending barely being able to grow. The hope here stems from a decline in inflation. Fuel prices have come down. That is re-imbuing consumers with a little bit of extra disposable income that wasn't there before, and the hope that ultimately this lower inflation by the second half of this year might enable the Reserve Bank to start reducing interest rates. But we're looking at growth in consumer spending of no more than 1%, if not a little less than that. At least the good news is that despite everything, economic activity is not collapsing. And that's really quite positive. If one goes ahead and looks at the outlook, one realizes that a very important constraint at the moment on economic activity on the willingness of people to invest is the prospect of a general election. This is creating some uncertainty, and people are not quite clear as to how to interpret this general election. As I see it, there are three major scenarios that one can look at. The first, probably the scenario with highest probability, is the likelihood that the ANC will either just retain its majority or get a substantial minority vote that is high enough for the party to join in coalition with a small party to push its vote, the combined vote, to over 50%. And what we would end up with is basically a continuation of what we've been having. The second scenario, which is a more ominous one, which sees the ANC losing substantially and getting in no more than, say, 40% of the vote or even less. And the risk that frightens everyone is of the ANC then moving into alliance with the EFF. And that would almost certainly see a shift in economic policies towards populism, high levels of government spending, abandoning fiscal rectitude, spending a lot on social delivery, social services that are not supported by real economic activity. And at the end of the day, you'd likely see a collapse in the rand and a disastrous economic outlook. The third scenario, if one wants to be a little more optimistic, is to suggest that this multi-party coalition that is that attempts are being made to form, and there are already quite a lot of political parties that are aligned to that, might be able to join with elements of the ANC. Effectively, it implies, or virtually, a breakup of the ANC and the adoption of certain changes in philosophy, an attack on corruption, and a gradual turnaround in the fortunes of the South African economy. Let us just look at these in a little more detail now. If we go forward, you'll notice that if in the first case scenario, if the ANC basically still maintains its role as the dominant political party, it really speaks to the situation with our economy remaining more or less in status quo. You're still going to have cadre deployment that leads to corruption and incompetence amongst public servants. You're still going to see SOEs being pursued, being supported at the expense of the taxpayer, even though, and difficulties in actually generating any form of cohesion within them. And, you're going to, at the end of the day, I don't see the economy really picking up much momentum, because it's going to be a continuation of what we've been seeing in recent years. And the likelihood then is that growth in government revenue will lag behind expenditure continuously, because the government will press ahead with social programs and social protection, social grants, and that kind of thing, and have to help the SOE, bail out the SOEs, and you end up with a gradual increase in budget deficits and public debt, which won't come down very well. The rand will carry on losing ground over time, but at least there will be an element of stability in terms of continuation of the status quo, and that should prevent a complete collapse of the economy. The next scenario, however, is the one that people are very concerned about, and that is scenario of the EFF, an alliance with the EFF, and you start seeing the adoption of populist policies of expropriation without compensation, basic income grant, national health insurance scheme, and suddenly government spending goes totally out of sync with what the country can afford. Eventually, that causes interest rates to surge. The very short-term impact would be a collapse in the rand, but ironically, on the real economy, the short-term impact of such an alliance, unfortunately, could be quite positive, because suddenly you'll see spending where there was no spending, and you end up with lower economic. You have higher economic growth in the short term, but in the longer term, you end up with significantly lower economic growth. The third scenario, which is probably the one that one would hope would transpire, is of a new coalition in government that would actually help to bring about a change in the kind of direction of the country, and the adoption of far more private sector involvement in economic activity that would then see a turnaround in our economic fortunes. But people are very nervous about, having seen what's happened to many municipalities, about these coalitions and the manner in which they can really operate efficiently. There is a challenge of subduing the egos of the leaders of each of these smaller organizations. And, so there's a long way to go if we are to start seeing the generation of more rapid economic activity. So essentially, the take I have, my take on the economic prospects of the next couple of years, is that we are going to be stuck in a range of economic growth of no more than 1.5%. And if one wants to be optimistic, you can only be really optimistic about the scenario after 2026 or so. Obviously, if one goes forward, you realize that that kind of economic growth prospect, as the projections in our economic growth forecasts in the next slide show, is fairly dismal. We are seeing at most some support from higher fixed capital formation, a little bit of the renewable energy projects and the transmission or moves to encourage transmission of electricity, providing some growth, coupled with the benefit of lower interest rates and lower inflation, helping to just support a minimal amount of economic growth. But it's likely to be insufficient to really bring down the pressure on government to spend on various social services. And the likelihood is that you'll see budget deficits expanding and the public debt increasing. And in the bottom graph here, I show our projection of what is likely to happen to the public debt. We've got it rising to 89% of GDP by 2027. Interestingly, over the weekend, Fitch brought out its latest announcement on ratings and left our credit rating unchanged at 3 notches below investment grade, BB minus, and maintained a stable outlook. Essentially, what it says is that certainly for the next year, there is little likelihood of a downgrade in our credit rating, but there was an underlying warning that essentially we cannot allow this public debt to carry on rising indefinitely without eventually experiencing a credit rating downgrade. And the negative implications of a further credit rating downgrade is that long-term interest rates would rise still further than they are currently. Currently, you've got long-term interest rates at anywhere between 10 and 13%, with inflation closer to 5%. That's a real long-term interest rate of between 5 and 7%. It's a hell of a high risk premium that government is having to pay on account of its not being able to grow the economy fast enough to be able to afford the expenditures it's incurring. And if it doesn't do something to encourage higher economic growth and higher tax revenues, then eventually we will be downgraded still further to 4 and 5 notches below investment grade, which will mean long-term interest rates moving upwards to more like 13, 14, 15%, even if inflation is quite low at 5 or 6%. Already our debt servicing costs amount to 20.9% of government revenue and are squeezing out the government's ability to spend on everything else. Now, that is not the base case scenario. The base case scenario, as I said, is edging our public debt to GDP ratio upwards by about 4% every year to 89% in 2027. And that appears to be palatable for the ratings agencies, but they are warning if we don't do more to encourage higher economic growth, then eventually a ratings downgrade will emerge. But for the moment, the outlook for credit ratings for the next year is stable. So we must be grateful, and that means that we're in a situation where our long-term interest rates are likely to remain at their current levels, with a slightly upward bias, but not too terrifying. And under those circumstances, it does make sense to have significant exposure to South African government bonds, because you're earning a very high real interest rate with relatively little risk of capital loss. There is a risk of capital loss, especially under an ANC-EFF coalition. And if the government continues to fail to generate any improvement in growth, but for the moment, you can secure a fairly good return on South African government bonds as a consequence of the scenario I've painted. If we go on to then look at the implications for inflation, or what we're looking at for inflation, here the story is a more favorable one. Especially in December, we saw a significant cut in fuel prices, which was repeated again in January. Tomorrow, we're seeing the December CPI inflation rate being released, and there's every chance that we'll see a further decline in inflation from 5.9% in October to 5.5% in November, down to anything between 5.1 and 5.3% for December, on the back of those fuel price cuts. Now, ironically, when the January figure is released in a month's time, that may show a countervailing, fairly substantial spike upwards in inflation, simply because in January 2023, fuel prices fell by more than 2 Rand a litre. So on a comparative basis, even though fuel prices fell further in January this year, there will still be an upward move in the year-on-year fuel inflation rate. But then we'll see come March, April, then we'll be comparing with sharp falls, sharp increases in fuel prices a year ago, and that in turn will cause the inflation rate to come back down again towards the middle of the year, reaching 5% or maybe even less than that. And that's quite good news for the outlook for interest rates in the second half of the year, because by then we will certainly, if you go on to the interest rate outlook, we'll be looking at interest rates falling by 2 or 3 25 basis point cuts through the course of the second half of this year. And that ties in very well with the Reserve Bank's own quarterly projection model that sees the repo rate ending 2024 at 7.55%, which is 70 basis points below the current repo rate, implying somewhere between 2 and 3 cuts of 25 basis points in the repo rate. You're not going to see any cut in interest rates anytime soon, however, for the very reason that I've painted, that the inflation for the next few months is going to remain stuck well above 5%, and under the circumstances, Lesetja Kganyago already said that at the World Economic Forum, there is little chance that he's going to rush to cut interest rates anytime soon, or the Monetary Policy Committee will rush to cut interest rates soon, when the really objective is to get inflation down to 4.5%, which is the real inflation target that they are pursuing at the moment. So obviously, the other factor that will influence the timing of our interest rate cuts is what happens internationally. Certainly towards the end of last year, there was a sudden pivot towards expecting that US and Eurozone interest rates would come tumbling down through the course of this year by as much as 25 basis point reductions. But that has been tempered more recently in the face of strong economic growth in the US and comments made by central bank governors who are saying, whoa, don't overdo your optimism regarding the outlook for interest rates. And I would agree with them in that regard, that inflation is likely to prove a little more sticky than the markets are suggesting. And we have seen it with the latest December inflation figures that have been released overseas, how there's been a bit of a kick up in those inflation forecasts. The other factor that obviously can affect our interest rate forecast is the outlook for the Rand. And in that regard, if one looks at where the Rand has been in recent times, it has been very weak, but it hasn't weakened a lot further than it had been doing. We hit 19 Rand 90 to the dollar in May last year. We're now at 19.15 or whatever. So against the dollar, we're quite a bit stronger than we were in May last year, although we have weakened against the likes of the pound and the euro. So on average, the Rand has not gained any ground in the last 9 months, but hasn't lost a lot of ground to push inflation up a lot further. And on a real trade weighted basis, as the third graph from the top here shows you, the Rand is very cheap compared with where it has traded at for the last 30 years. It's close to its all-time lows. Now, does that mean it can rally strongly? And my answer is no. Unfortunately, there are a lot of headwinds facing the currency that are still in place. The first is that commodity prices are looking dodgy, and we've got those port bottlenecks that are preventing our exports from generating as much export revenue as we would like to have seen. Secondly, economic growth is so weak that government revenue, and for that matter, company tax revenue, has come down quite a lot, and that means higher budget deficits and a rise in the public debt, with the kind of risks that I've alluded to in terms of longer term having further credit ratings downgrades if we don't do something about that. In the face of that, the Rand cannot really recover very strongly. Thirdly, we've still got grey listing in place, which has increased the cost of doing business with South Africa. Fourthly, there have been big questions asked about our foreign relations. Our primary investors come from the West, and yet our foreign relations have been pandering to the whims of the East. And then finally, of course, there is this uncertainty regarding the outlook for the general elections. And as a consequence, one doesn't see the Rand gaining a lot of ground. But by historical standards, a lot of the bad news has already been discounted, and therefore one sees the currency not tumbling a lot further. You see the forecast that we've got that sees basically the rand averaging around 18.5 to 19 to the dollar over the coming year or two, gradually losing ground over time. But that's not horrifically dodgy and potentially inflationary scenario. However, there is an massive downside risk should we end up with an ANC, EFF, MK coalition that sees economic policy moving more to the left, abandoning fiscal austerity completely, just printing money, and we end up with massive inflation and foreign relations that pander to Russia and China and the others completely. And you see disinvestment as a consequence by the West from South Africa. Obviously, much depends on what the international environment looks like. And was an interesting study that was released last week by Allianz Insurance Company, looking at the major risks. Obviously, it's with the interests of insurance companies foremost in their minds, but it does show you what the outside perceptions are. And you'll see that out of over 3,000 companies that were interviewed, 40, they each had to give their 3 biggest risks of investment in different countries. And for the world, it's very interesting that by far the biggest risk is seen as cyber security and incidents. And the second biggest risk is interruption to supply chains. A remnant of the COVID crisis. There's been a big increase internationally in the risks perceived of natural catastrophes as well. But in South Africa, by far the biggest is the risk of blackouts and load shedding. 40% of respondents cited that as one of their 3 major risks. And that compares with just 8% internationally. So you can see the difference in the kind of risks that are being seen. Other risks that are associated with South Africa that are much higher than in the rest of the world, though the one that stands out for me is, of course, theft, fraud, and corruption, which has moved upwards quite a lot, and is now significantly higher, seen as a bigger risk than is the case internationally. On the other side, it's interesting to note that the political risks in South Africa are not seen. That political risk has been seen to come down somewhat, whereas internationally it has actually increased a lot. And the associated geopolitical risks are reflected in risks of fire and explosion internationally rising a lot. And then, of course, natural catastrophes is not confined. The increase in the perceived risk of natural catastrophes is not confined to the world alone. South Africa is very much part and parcel of that. And we've seen that, of course, with the situation in KwaZulu-Natal. If one then goes on to look at risks on a more general basis, I've highlighted what I see as the major risks domestically and the major risks internationally. Domestically, we've mentioned load shedding, logistics, crime and corruption, and ineffectual government, especially our public service, especially at municipal level. And then associated with those, of course, low economic growth and associated fiscal risks. Internationally, the big risks are, and this is a big new one that is looming larger and larger, and we'll have an even bigger, better idea of this tonight when we follow the primary elections in the US and New Hampshire, the risk of a Donald Trump presidency in the US between 2025 and 2028. And there is no question that at the World Economic Forum last week, the fear was expressed of major protectionism by the US, not only against China, but against Europe and the rest of the world. There is a perception that Trump will lead the path to a 10% tariff on all imports into the US, move towards inward industrialization in the US, which would be terribly damaging for global economic growth. And by the way, should you start seeing more and more moves in that direction in the coming year, for me, that's a huge risk to the course of the current equity bull market. Secondly is, of course, geopolitical tensions and where those could end, and the way in which they could lead to an exacerbation of supply shortages and higher costs, especially of certain commodity prices. The third very big risk that I foresee is high levels of global public debt. As a result of the global financial crisis and trying to get out of that mess 15 years ago, and then subsequently trying to get out of the COVID-19 mess 3-4 years ago, we have seen a huge escalation of public debt amongst leading industrialized countries. And with debt levels at record highs or near record highs, the capacity of countries to intervene to actually act and stimulate their economies in the face of slowing economic growth in the wake of higher interest rates is very, very limited. And we could be facing a decade of far, far lower economic growth than we've been accustomed to. Obviously, linked to geopolitical concerns is the risk of higher energy costs and supply disruptions. And then, of course, the last one is major natural disasters. Last year was the hottest in living memory, and suggestions are that 2024 will be even hotter, with concomitant fires and floods that might pursue. Those are the issues that we have to look at risks. But let's narrow it down to more focused on our financial markets and globally and what this means. I've already mentioned how inflation has come down around the world and created, until a few months ago, a lot of complacency about the extent to which interest rates might be reduced. And you can see in the middle left-hand graph how the US has, through quantitative tightening, caused its Fed's balance sheet to contract significantly, and that goes hand in hand with inflation. Yes, there has been a negative impact as manifested by the fall in the PMIs of your leading industrialized regions of the world, the US, Eurozone, and China. In all cases, though, you'll notice that manufacturing has weakened more than services. But and so that has also encouraged the belief that interest rates could come down a long, long way. But if you go to the other considerations, in the next slide, you'll notice that it's all very well to talk of a slower economic growth, but it's not slackening off that much. You can see, yes, on the top right-hand graph, you can see how the growth in job creation in America has gradually slowed, but it's still running at the rate of 170,000 a month. The unemployment rate is not coming down, and is not rising much. It's remained stuck at 3.7%, a 50-year low. And wage increases have slackened to 4%, but they're not coming down below that, which is inimical to the notion of getting inflation down to 2%. And then, of course, you've got to bear in mind that public debt levels are so high. There's one important implication of that that I brought up at the last post-MPC meeting with the Reserve Bank, and they agreed totally that what keeps them up at night more than anything globally, this was after the Jackson Hole meeting as well, and the IMF meetings that they had in October and that they all attended. What keeps central bankers up at night is the high levels of public debt that prevail around the world. And so I said to them, does that not mean that real interest rates have to remain higher than they would otherwise have been? And the response I got from all our governors and deputy governors was absolutely. And that is why I think one needs to be very circumspect about hoping that interest rates will come down to the extent that markets have anticipated. In the bottom left-hand graph, you can see both the market forecast in black, and in green is the lower end of the forecast range of Fed governors in the dot plot. The yellow forecast is the median. And you can see the divergence that has emerged between market anticipation of what interest rates will do and what central bankers are saying. And until the recent weeks, that was a glaring gap. And what we've seen in the last couple of days is that black and the green line seem to be, or the black line really, is gradually shifting back upwards to be closer to the yellow line, and that's creating a little bit of nervousness in global bond markets, where bond yields have kicked up again after the bull run that they had at the end of last year. So my take on interest rates around the world is that yes, they've reached their peaks because inflation has reached its peak, but they're not going to come down anywhere near to the extent that markets appear to have suggested in recent times. If we go to the next slide, we'll see that what that, of course, means for financial markets is that, yes, we're looking at an environment in which is stronger than we anticipated, which means that company earnings could do better than we had thought, and that is supportive of higher equity prices. But then against that, you've got to bear in mind that economic growth may remain lower for longer than we have anticipated been anticipating. And for that reason, I believe that equities are really fully valued internationally. It has been that for South Africa. JSE is probably quite depressed and probably offers better opportunities from an equity point of view than some of the international equity markets. But at the same time, even the latter have been distorted to some extent by the fact that the strength of equity markets has been very much confined to IT, the big IT companies. And to some extent, there's a distortion there, and there's over-exuberance about potential growth, especially from the developments with regard to AI that have seem to be creating a lot of excitement, but I think are being somewhat overdone. In relation to bond yields, where I think one's going to stick with relatively high interest rates, but that the risk of capital loss is that I think a lot smaller than it is with equities. I would still be tilting towards favoring bonds over equities at the margin. Obviously, one needs a diversified portfolio, but at the margin, I would favor new investment more in bonds internationally than in equities. And for South Africa, I suppose it's a better balance where equities are already quite depressed and are offering significant value, but so too are our bonds. So in South Africa's case, I think the balance between equities and bonds is more equitable than, whereas from an international point of view, I just feel that equities could have another short-term run further up, but I would get very, very scared if that were to take place. I've highlighted a lot of the risks that could still manifest themselves over the rest of the year, and I am terrified of what a Donald Trump presidency in the US could mean for the world economy, actually. Thank you very much. I'm happy to take questions.